Fear exits. That's what most people don't call them, but that's what they are. They dress them up as discipline, as prudence, as being safe. But underneath, it's fear doing the talking. I learned early that the market doesn't frighten a man all at once. It frightens him inch by inch, tick by tick, until he no longer trusts his own judgment. Have you ever noticed how confident you feel before you put on a trade, and how unsure you become the moment money is at risk? Trading feels scary because the market has a way of making everything personal. A chart is just a record of prices, yet once you're in a position, every bar feels like it's aimed at you. That's not because the market knows your name. It's because your capital is exposed, and your mind suddenly becomes very alert to danger. You're no longer reading the chart. You're reading your own pulse. Isn't it strange how a clean setup looks obvious before entry and questionable the moment you're in? Most fear exits happen not because the trade is wrong, but because time has passed without reward. A position sits there, not moving the way you imagined, and impatience starts whispering. Maybe I'm early. You think, maybe I misread it. The chart hasn't changed, but your tolerance has. I've always found that the market tests patience before it pays profit. Do you give your trades time to work, or do you expect them to perform on command? Charts don't shout. They speak quietly, and fear makes it hard to hear them. A normal pullback looks like a disaster when you're undercapitalized or over-leveraged. That's why position size matters more than cleverness. A man trading too large cannot think straight. He watches every fluctuation as if it were a verdict on his intelligence. When you exit early, ask yourself, was it the chart that told you to leave, or the size of the position that made you nervous? Trading feels scary because losses feel final, even though they aren't. One loss has a way of dragging all the past ones back into the room. You remember how it felt the last time you were wrong, and the time before that, and soon you're not trading the current setup at all. You're trading your memory of pain. The market doesn't punish you for being wrong. It punishes you for refusing to think clearly. Are you reacting to what's in front of you, or what happened last week? A fear exit often comes right before the trade proves itself. That's not coincidence. Markets shake out weak holders the way a strong wind shakes dead leaves from a tree. The movement is designed to test conviction, not to announce a trend change. The professional understands this and waits for the chart to confirm his mistake before admitting it. The amateur guesses, and guessing is expensive. How often have you sold only to watch price move exactly as you first expected? There's a difference between being cautious and being afraid. Caution comes from preparation. Fear comes from uncertainty. If you didn't know where you were wrong before you entered, you will certainly not know when to exit. That's why I always believed a man must decide his risk before the trade, not during it. Once the trade is on, the market has the floor. Do you define your risk calmly ahead of time, or do you negotiate with yourself while the chart is moving? Wealth in trading is built by sitting, not by flinching. The big money is never made in the buying or the selling, but in the waiting. Fear exits steal that waiting from you. They turn a planned campaign into a series of nervous skirmishes. You begin to trade your emotions instead of the trend. Over time, that habit drains both capital and confidence. Have you noticed how frequent exits make you feel busy, but not productive? Another reason trading feels scary is that profits feel unreal until they're taken, while losses feel real the moment they appear. A small drawdown can feel heavier than a larger unrealized gain. This imbalance twists judgment. The trader reaches for certainty, even if certainty means a smaller result. The market, however, rewards those who tolerate uncertainty with discipline. Can you sit through discomfort when the chart still agrees with you? Fear exits also come from watching too closely. Staring at every tick magnifies noise into meaning. A man who checks his position every minute will find a reason to doubt it every minute. Charts were never meant to be watched like a heart monitor. They're meant to be read, then respected. Once you've made your decision, excessive watching adds nothing but anxiety. Do you give the trade room to breathe, or do you suffocate it with attention? I've seen traders with sound methods fail simply because they couldn't stay put. They knew how to read accumulation, they understood trends, but they lacked faith in their own work. Confidence in trading isn't bravado, it's familiarity. It comes from seeing the same patterns play out over and over again and trusting the math of experience. Without that, every trade feels like a leap in the dark. Are you trading a method you truly understand, or one you borrowed and hope will save you? The market is an honest teacher, but a harsh one. It exposes every weakness of temperament. Fear exits reveal impatience, overexposure, and lack of preparation all at once. They feel like relief in the moment, but regret soon follows. The trader who learns to sit through them learns something far more valuable than any indicator. He learns himself. Unplanned exits are decisions made under emotional pressure, and that pressure rarely announces itself honestly. It doesn't say, "I'm afraid." It says, "I'll enter later," or "something doesn't feel right." That's how fear speaks to a trader who wants to believe he is still thinking clearly. The chart may be doing exactly what it should, but the trader's nerves have begun to argue with his plan. Have you ever noticed how a trade feels heavier the longer you sit in it without reward? When a position is entered without a clear exit point already decided, the mind starts improvising. Improvisation has its place in life, but not in speculation. The market moves fast, and a man under pressure will always choose relief over logic. The moment price ticks against him, he feels the need to do something. That urge is not analysis, it's discomfort trying to escape itself. Isn't it interesting how selling feels like taking control, even when it's the worst possible decision? Emotional pressure builds quietly. It comes from trading too large, from needing the trade to work, from watching unrealized profits slip away. A trader who is financially comfortable can wait. A trader who is mentally or financially stretched cannot. The chart becomes secondary to the feeling in his chest. He is no longer asking what the market is doing, but how much more uncertainty he can tolerate. At that point, the exit has already been decided by emotion, not price. How often have you exited simply because you wanted the tension to stop? The market has a way of lingering just long enough to expose impatience. A position may move sideways, respecting support, holding structure, doing nothing wrong at all. Yet to the trader inside it, inactivity feels like danger. He begins to imagine what could happen rather than observe what is happening. This imagined future becomes more real to him than the chart itself. That is emotional pressure at work, bending perception. Do you notice how fear fills the silence when price pauses? An unplanned exit is rarely about avoiding loss. More often, it's about avoiding doubt. Doubt eats at confidence, and confidence is a trader's most valuable capital. When a trader sells prematurely, he feels a brief sense of clarity. The position is gone, the risk is gone, and with it the responsibility of being right. But the market does not care about that relief. It continues on its path, often proving the original trade idea correct after the trader has already stepped aside. How many times has the market moved cleanly once you were no longer in it? Emotional exits also come from confusing pain with information. Price pulling back is not information, it's movement. Information comes from breaks of structure, from volume behaving differently, from conditions changing. Pain, on the other hand, comes from expectation. When price fails to meet expectation quickly, the trader interprets that delay as danger. He forgets that markets breathe. They advance and retreat. Only the unprepared man believes price should move straight to his target. Do you expect your trades to behave like machines instead of markets? The trader who exits emotionally believes he is being prudent. He tells himself he is protecting capital. In truth, he is protecting his feelings. Capital is best protected by rules, not reactions. A stop placed in advance is protection. A fear-based exit is surrender. One is planned loss. The other is abandonment of a plan. Over time, this distinction makes all the difference. Have you noticed how repeated fear exits make you trust yourself less with each trade? There is also the matter of time. Emotional pressure increases the longer a trade remains unresolved. A man who understands time allows price to fluctuate without interference. A man who does not becomes restless. He checks charts constantly, seeks reassurance, changes time frames, searches for reasons to act. Each action increases pressure instead of reducing it. The market rewards patience, but patience cannot exist without emotional control. Do you let time work for you, or do you fight it every step of the way? Unplanned exits train bad habits. Each time a trader exits early and avoids short-term discomfort, he reinforces the belief that discomfort is dangerous. The next trade becomes even harder to hold. This cycle erodes discipline slowly but surely. Eventually, the trader finds himself unable to sit through even normal fluctuations. He becomes reactive, defensive, and inconsistent. The chart hasn't changed, but his behavior has. Can you see how emotional decisions today shape tomorrow's losses? The disciplined trader accepts discomfort as part of the business. He does not enjoy it, but he does not flee from it either. He knows that pressure is the cost of opportunity. By deciding exits in advance, he removes emotion from the moment of decision. When price reaches his invalidation point, he exits without debate. Until then, he waits. That waiting is not passive, it is intentional. It is confidence expressed through stillness. And when a trader finally understands that most bad exits were never caused by the market, but by the pressure he allowed to build inside himself, he begins to see trading differently, and the struggle becomes quieter, more internal, and far more revealing. Watching price too closely turns noise into false danger, and nowhere is that more evident than on a trader's screen during an open position. The chart that looked calm and orderly before entry suddenly feels restless once money is involved. Every small bar looks suspicious. Every pause feels like a warning. The trader leans closer, refreshes the chart, drops to a lower time frame, searching for certainty where none is required. Have you noticed how the closer you watch, the less confident you become? Price is never still, and it was never meant to be. Markets move by fluctuation, not by straight lines. Yet the human mind wants smoothness, especially when risk is present. When a trader watches every tick, he begins to mistake normal movement for meaningful change. A single red bar feels like rejection. A brief pullback feels like failure. The chart hasn't changed its story, but the trader has changed how he listens. Are you reading the market, or reacting to every sound it makes? Noise is not the enemy until attention turns it into one. Most intraday movement is meaningless in the context of a larger structure. Support remains support even if price dips slightly below it. Resistance remains resistance even if price probes it twice. But the trader who watches too closely sees these probes as breakdowns. He exits, not because structure failed, but because patience did. Isn't it curious how the same move looks harmless when you're not in the trade? Constant monitoring creates the illusion of control. The trader believes that by watching closely, he can protect himself. In reality, he is exposing himself to emotional overload. The brain was not built to process continuous uncertainty without fatigue. After enough watching, decision quality deteriorates. The trader becomes jumpy, eager to act, desperate to end the tension. That action often takes the form of an early exit. Have you ever closed a trade simply because you were tired of watching it? The market rewards perspective, not proximity. A chart viewed from too close loses context. Trends disappear. Ranges look chaotic. The trader forgets why he entered in the first place. His original reasoning fades, replaced by momentary impressions. This is how good trades are abandoned and poor habits are formed. The trader exits not because the trade is invalid, but because his focus has narrowed too much. Do you step back to see the whole picture, or do you let the smallest movements dictate your actions? Watching price too closely also encourages constant second guessing. The trader begins to imagine alternative entries, better exits, missed opportunities. He compares what is happening to what could have happened. This mental comparison breeds dissatisfaction. The current trade feels inadequate, even if it's unfolding properly. That dissatisfaction fuels impatience, and impatience looks for an escape. How often have you sabotaged a solid trade because you imagined a better one? There is a difference between monitoring and hovering. Monitoring is deliberate and spaced. Hovering is compulsive. The hovering trader checks price after every candle, every update, every fluctuation. He seeks reassurance but finds only more questions. Each glance adds another layer of interpretation, another chance for doubt to creep in. Eventually, doubt demands action. The trader sells, not because of evidence, but because of exhaustion. Have you felt that sense of relief after exiting, even when you knew it wasn't justified? Markets are designed to test conviction through movement. Small reversals, false breaks, and pauses are not accidents, they are part of price discovery. The trader who understands this allows room for uncertainty. The trader who watches too closely tries to eliminate uncertainty, and in doing so, eliminates opportunity. You cannot extract profit without tolerating ambiguity. The chart will never give continuous comfort. Do you allow space for the market to do its work? Overwatching also distorts time perception. 5 minutes can feel like an hour when price stalls. A single session can feel like a verdict. The trader forgets the time frame he is trading and begins to act as if every moment matters equally. Long-term trades are managed like scalps, and swing positions are judged by intraday noise. This mismatch creates unnecessary exits. Are you trading the time frame you planned, or the one your emotions drag you into? A well-prepared trader knows when not to look. He enters with a plan, defines his risk, and steps back. He understands that his job is not to babysit price, but to let probability play out. The market does not need supervision. It needs patience. Watching less is not negligence, it is discipline. The less you interfere, the clearer your decisions become. When a trader learns that most of the danger he sees while watching price closely is imagined rather than real, he begins to reclaim control over his behavior, and the chart slowly returns to what it always was. Discomfort is not a signal unless price confirms it, yet most traders treat discomfort as if it were a warning siren. The moment a trade begins to feel uneasy, the mind assumes something must be wrong. The body tightens, attention sharpens, and the urge to act takes over. But the market does not communicate through feelings. It communicates through price. Have you noticed how often discomfort appears long before the chart gives any real reason for concern? Every trade worth taking carries uncertainty. If it didn't, there would be no opportunity. The problem is that uncertainty feels uncomfortable, and the human mind is wired to escape discomfort. In trading, that instinct is costly. A trader who mistakes emotional tension for market information will exit trades that are still valid. He will confuse internal pressure with external evidence. The chart may be holding structure perfectly, yet the trader feels compelled to intervene. Are you responding to price, or to the sensation of waiting? Discomfort often shows up when a trade stops behaving according to imagination rather than analysis. The trader expects momentum, but price pauses. He expects follow-through, but price pulls back. None of this invalidates the trade, but it violates expectation. That violation creates tension. The trader begins to interpret normal behavior as abnormal. This is where many exits are born, not from broken levels or failed patterns, but from unmet timelines. Do you judge your trades by structure, or by how quickly they reward you? Price confirmation is unemotional. It does not care how long you've been in the trade, or how strongly you want it to work. Confirmation comes from facts: a level breaks and holds, volume shifts, trend structure changes. Discomfort, on the other hand, is vague. It has no shape, no rule, no consistency. One day it appears early, another day late. Building exits on discomfort is like navigating with intuition alone. It feels responsive, but it lacks reliability. How can something so inconsistent be trusted with capital? Many traders exit when price moves against them slightly, not because the trade is wrong, but because discomfort spikes. That spike often comes from oversized positions. When risk is too large, even small movements feel dangerous. The trader interprets his anxiety as insight. He believes he is sensing trouble, when in reality he is sensing exposure. Reduce the size, and the signal disappears. Was it really the market warning you, or your position size shouting too loudly? Discomfort also increases when a trader watches unrealized profit shrink. A trade moves in his favor, giving him a glimpse of reward, then pulls back. That pullback feels like loss, even though nothing has been lost yet. The trader focuses on what was available rather than what is still probable. This creates fear of giving back gains that were never secured. The chart may still be constructive, but the trader exits to preserve emotional comfort. Have you ever sold just to stop feeling foolish for not taking profit earlier? The disciplined trader understands that discomfort is part of staying aligned with probability. Trends are not smooth. They advance, hesitate, and retrace. If a trader exits every time he feels uneasy, he will never stay long enough to benefit from sustained movement. He will capture only fragments while avoiding the very periods that generate meaningful returns. Price confirmation acts as a filter. It prevents emotional noise from dictating action. Do you wait for evidence, or do you let feelings rush the decision? There is also the issue of self-doubt. Discomfort often emerges when a trader questions his own judgment. He replays the entry in his mind, wonders if he missed something, imagines scenarios where he is wrong. None of this changes the chart, yet it changes his confidence. That loss of confidence becomes unbearable, and the exit provides relief. Relief, however, is not validation. The market does not reward comfort. It rewards correct positioning. Are you seeking to be right, or to feel safe? A trader who learns to separate discomfort from information gains a powerful edge. He stops reacting to every emotional fluctuation and starts listening for structural changes. He knows that feeling uneasy is not a reason to act. It is a reason to check the chart more objectively. Has price violated the level that proves the trade wrong? Has volume confirmed weakness? If not, he stays. This discipline transforms trading from a nervous activity into a measured process. Discomfort becomes dangerous only when it is misunderstood. It is not a message from the market. It is a message from within. Sometimes it points to flaws in preparation, such as poor risk definition or lack of conviction. Other times, it simply reflects the cost of waiting. By acknowledging discomfort without obeying it, the trader strengthens emotional control. Over time, discomfort loses its authority. It becomes background noise rather than a command. When price finally does confirm that a trade is wrong, the exit feels different. There is clarity instead of panic. The trader does not argue or hesitate. He acts because the market has spoken, not because his nerves have. This distinction separates professionals from amateurs more than any indicator ever could. And as a trader spends more time allowing price to make the final decision instead of his emotions, he begins to notice that the discomfort he once feared was never a warning at all. Confidence grows from repetition, not prediction, and that truth runs against nearly every instinct a new trader brings to the market. Most people come in believing confidence is something you earn by being right. They think if they can just predict the next move correctly, everything else will fall into place. But trading doesn't work that way. The market humbles predictors quickly. Confidence built on forecasts is fragile because the moment price does something unexpected, it collapses. Have you noticed how sure you feel before a trade and how quickly that certainty disappears once price hesitates? Prediction creates emotional attachment. When a trader predicts, he wants the market to agree with him. His identity becomes tied to the outcome. If price moves against the prediction, it feels personal. Doubt creeps in, fear follows, and discipline weakens. That kind of confidence is borrowed and temporary. Repetition-based confidence is different. It comes from doing the same process over and over again, regardless of outcome. The trader stops asking, "Will this work?" and starts asking, "Did I execute correctly?" Can you feel the difference between those two questions? Repetition builds familiarity, and familiarity reduces fear. When you've seen the same setup fail and succeed dozens of times, no single trade carries much emotional weight. You stop expecting perfection. You stop needing confirmation from every candle. You know the range of outcomes, and you accept them. That acceptance is what steadies the hand. A trader who relies on prediction is always surprised. A trader who relies on repetition is rarely shaken. Are you still surprised by normal market behavior? Markets are uncertain by nature. No pattern, no indicator, no method removes that uncertainty. Prediction tries to conquer it. Repetition learns to live with it. The trader who predicts spends his energy trying to foresee the future. The trader who repeats spends his energy refining execution. Over time, one becomes anxious and reactive, the other calm and consistent. Consistency is where confidence lives. Do you notice how calm traders are rarely the ones talking about what the market will do? Repetition also exposes flaws honestly. When you take the same type of trade again and again, Patterns appear, not just on the chart, but in your behavior. You see where you exit early, where you hesitate, where you overreact. This feedback loop is invaluable. Prediction hides these flaws, because every loss can be blamed on being wrong about the move. Repetition removes that excuse. It shows you that success is procedural, not prophetic. Are you willing to look at your behavior as closely as you look at price? Confidence built through repetition doesn't spike after a win or collapse after a loss. It stays level. That steadiness allows better decisions. The trader stops chasing and stops freezing. He knows that no single trade matters much, because he will be doing this again tomorrow and the day after that. This long view is what separates speculation from gambling. Gambling lives on the next outcome. Trading lives on the next 100. How many trades ahead are you thinking? Prediction encourages overconfidence when it works. A trader guesses right a few times and starts to believe he has special insight. Position size increases, rules loosen, discipline fades. The inevitable loss then does more damage than it should. Repetition prevents this inflation. It reminds the trader that wins and losses are both part of the same process. Nothing special happened. The method played out. Confidence remains grounded. Have you ever noticed how quickly a hot streak can undo itself? There is also freedom in repetition. When you stop trying to predict, you stop arguing with the market. You wait for conditions you recognize. You act when they appear. You manage risk the same way every time. This removes mental clutter. The chart becomes simpler. Decisions become clearer. Confidence grows quietly, without excitement or fear. It doesn't announce itself. It just shows up in how little you interfere. Do you find yourself interfering less as you gain experience? Repetition teaches patience. A trader learns that opportunities are not rare events to be seized at any cost. They are recurring situations that appear again and again. Missing one doesn't hurt as much when you trust that another will come. Prediction makes every trade feel urgent. Repetition makes waiting easier. And patience is a form of confidence. It says you trust your process enough to let things pass. Can you let a trade go without feeling left behind? The market doesn't reward those who know what will happen next. It rewards those who behave well when they don't. Repetition trains behavior. It builds muscle memory. It replaces emotion with routine. Over time, the trader stops needing reassurance from predictions. He doesn't need to be right. He needs to be consistent. That consistency compounds, not just in capital, but in composure. And as repetition replaces prediction, confidence stops feeling like something you summon and starts feeling like something that's simply there, quietly guiding each decision without noise or strain.